Welcome back to Personal Pension Radio. This is episode 255. This is the quick take. I want to share something with you today about the Monte Carlo simulation. The Monte Carlo simulation. What do you think about when you hear Monte Carlo? Maybe gambling? Yes. Maybe casinos. Gambling in casinos, right? Well, that's exactly it. The Monte Carlo simulation is a tool, a computer tool used to figure out the probabilities of various scenarios. And in our situation here in that financial planning space, Monte Carlo simulations are used in retirement planning scenarios. I'm going to show you that today on this quick take episode of Personal Pension Radio. Before I begin, don't forget, I am a certified financial planning professional, but I'm not a CPA. I'm not an attorney. I am a paralegal at an awesome law firm. But all of that aside, please don't act on things that you hear on this show as if you're getting advice for your specific situation. Please meet with a qualified, hopefully certified financial planner to go over your situation. Your circumstances are different from that person, from this person. Get the advice that's necessary for you to be able to make educated, well-informed decisions. There you go. Disclosure out of the way. Let's jump into this. Personal Pension Radio, the show itself, and my mission as the income engineer, yes, registered trademark, the income engineer, is to uncover or expose or discuss all of those things, the retirement income crisis in America, in our planning system, that's really driven by Wall Street education. Wall Street drives the education, and this question is probably the best way to explain why there's a retirement income crisis. Does Wall Street have any financial incentive to teach me how to teach you to take money, maximum amounts of money, out of the Wall Street system? Of course not. There's no financial incentive for Wall Street to have a great education plan for financial advisors to teach consumers how to take maximum amounts of money out of the Wall Street system. So the Wall Street system, unfortunately, is broken, in my opinion, on the income conversation side of the education. The conversation around retirement is always save, invest, 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 save, 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 invest, invest. That's not the whole journey. There's actually two sides to the journey, the accumulation phase and the distribution phase. I like the up the mountain and the down the mountain. The accumulation phase and the distribution phase, it's a two-part journey. You've got to have everything built right so that you can get to maximum distribution. So Wall Street knows that distribution under the Wall Street only, investment only model, that distribution scenario is a challenge. There's a lot of risk involved in an investment only approach to retirement income. So Wall Street has this tool, this Monte Carlo simulation, which effectively helps validate or justify, whoa, let's put the brakes on how much you can take out of your investments. Whoa, we might have been telling you that you get an 8% rate of return average, or 7%, or like Dave Ramsey says, 12% average rate of return. Yeah, but that's on the accumulation side of the journey. That's when you were not taking any money out. But on the distribution side, yeah, you might want to be really careful. There's a lot of things that go into this, but maybe you should only take out this much to be careful. Remember, Wall Street has no big incentive to teach financial planners and advisors how to teach you to take maximum money out. So they have this tool, Monte Carlo simulations, that effectively try to validate why you shouldn't take a lot out. So let me show you that right now. All right, here we go. I have gone to a Monte Carlo simulation here online. You can Google Monte Carlo simulation, but you can also go to Vanguard and use their nest egg calculator. Now, the nest egg calculator is what you would search in Google to get there easily. And I've got a comment on it. I can't resist it. What does it sound like when you hear nest egg calculator? It sounds so warm and fuzzy, right? What you don't see on this page, by the way, is you really don't see anything that says Monte Carlo simulation unless you look down here. That's right, Monte Carlo simulation, kind of buried at the bottom of the calculator. We'll talk about that, but Monte Carlo simulation is what it's called. It was designed by mathematicians, oh gosh, centuries ago, to calculate the probabilities of uncertain events and risk. And it's used largely in the life insurance world, the pension world, investments. It's used in engineering. It's used in science all over the world in all different projects. But it is really big in the retirement income space because, as I mentioned, Wall Street has a financial incentive to hopefully slow us down on how much we take out of our investment accounts. So let's take a look at the retirement nest egg calculator after we just touch on the Monte Carlo simulation itself. So Investopedia, here's what the Monte Carlo simulation is. It is a model used to predict the probabilities of different outcomes and random variables, right? So this is the case that when you look at retirement income based on investments only, it's very uncertain. We have no idea what's going to happen year to year because investment markets and such are prone to ups and downs and risk. The part that really gets me in this definition, though, is that Monte Carlo simulations assume perfectly efficient markets. Perfectly efficient. Everything works the way it's supposed to work. It's very efficient. And I have to ask, right? Who among us believes that Wall Street or any investment market is perfectly efficient and nice and organized? It's crazy time. We never know what's going on. We never know some days why it's up and then why it's down, right? I just think it's funny that the Monte Carlo simulation, though, says, let's assume for a very long period of time that everything is perfectly efficient. That's not real life. It's not going to happen. All right, let's get to it. Let's take a look at an example. So when you load up the Monte Carlo simulation from Vanguard, and frankly, they all look very similar, you'll notice that we have three areas that we can manipulate here, three areas that we can affect. And remember, this is a calculation that you would use if all you had in your retirement income plan was investments based on risk. You got to be really careful with how much you draw out. So here the example defaults to a 30-year retirement. So think about this. If you retire at the stereotypical age of 65, well, you live to be 95. Let's figure out what the probabilities of success given the next two variables. Let's say that you have $1 million saved up in your investment account. Now, $1 million is a great number to use because you can go down or up fairly easy. You can see what your number would be. Now, notice this. The default percentage withdrawal rate, it's also called the draw rate. The default is 4.5. 4.5 as the default. Now, I'll tell you this, if you have heard my show over the years, the 4% rule has been around since the 70s, since the 70s, 80s. The 4% rule says, you know, we don't know how long you're going to live. We don't know whether the market's going to go up or down. You should probably only take out a draw rate of 4% from your investment account just to make sure that you don't run out of money. Did you catch that last part? Just in case you don't, we don't want you to run out of money if you live too long, right? So 4% has been the standard for years. It's interesting to me, though, that the Vanguard Monte Carlo model starts at 4.5. So let's take a look at some other variables here. Let's look down below and see what we've got. Now, the calculator is here. You can see the calculator in this nice, attractive, arced looking, pie-shaped thing. And what they're basing the calculation on by default is half of the investments being in some form of stocks, and 30% of the investments being in bonds, and 20% being in cash. Okay, that's the default that says if we have $1 million and we keep 50, 30, 20 as our investment package, and we draw 4.5% per year, not 4 and then 7% and then 2%, but 4.5% per year, and we adjust for inflation accordingly, all right? What are the chances that we're going to have success? Now, this is important. What does success mean? In the Monte Carlo simulation, this calculator will run 100,000 income scenarios. It'll run 100,000 calculations to find out which ones run out of money and which variables will take you all the way to the finish line 30 years out. So what are the probabilities that you would actually not run out of money? And vice versa, what are the probabilities that you might run out of money? So, based on the default, we've got to start there. We're going to click Run Simulation, running 100,000 simulations, and we come down here, we're calculating 100,000 simulations, and I want you to notice right here, we have probability that your savings will last is 83%. So think about that just for a second. There's an 83% chance of success. That means you have a 17% chance that you will run out of money before you die if you follow this 4.5% draw strategy. You see, that to me is unacceptable. Would any of us get on a plane from, let's say, California to Kansas if the pilot said, yeah, we're not sure if we're going to make it all the way to Kansas? I did not say that the plane will crash. I just said probably, maybe, we might make it, but we got a 17% chance that we may not make it to Kansas. How many of us would actually stay on that plane, right? If that was the last flight that we want to be on, right? So look at the numbers and to see, gosh, do we really like a 17% chance that we might run out of money before we die, right? Because we don't really have a chance to reset. We are at the start line, the finish line of accumulation, and the start line of distribution. We don't have an opportunity to go back and throw more money in the pot, right? Because Wall Street would say, well, you just need to save more money, right? You got to save more money. If you just save more money, then you'd be okay. Or, better yet, watch this. Let's test the 4% rule. Remember the 4% rule. Let's just take out 4%. So let's cut our lifestyle by a few $100s a month. Pretty good, right? And let's run that same scenario again. And let's see how the numbers improve. Do we improve? Running 100,000 simulations. Aha! Now, we have a 90% chance that we won't run out of money, right? We have a 90% chance that we won't run out of money. Now, of course, that means we have a 10% chance still that if we're married, a husband or wife, for example, one of us might die broke. What if one of the spouses is 5 years younger? They've got to live an extra 5 years. So we go over here and we say, well, what if we have to plan for 35 years because one of the spouses is actually younger, and we need to make sure that it lasts for as long as both shall live, and we run 100,000 calculations again, just out of curiosity. Oh, wow. So now we actually have an 86% chance of success. So we've gotten a little bit better. We've got a 14% failure rate. That's a 14% failure rate because we adjusted for longevity. Now, I know there's some out there that have read a lot of things online, or they've heard this old wives' tale or old financial advisor tale that says you should match your stocks and bond portfolio values to your age. So if you're 65 years old, you should have 65% in bonds, and that will make sure that things will last longer and you'll be okay. Well, let's do it. Let's check it out. So we can take our bond portfolio and we can grab it and we can ratchet it up to 65%. And we can maybe cut our cash down by, quite a bit. Let's do some numbers here. We'll take this to 65%. So we're doing this again. This is old school idea that says, how much money should I have in stocks and how much money should I have in bonds? Well, you should match your age to your percentage portfolio in bonds. Really? Does that work? Let's find out. Let's take all things being equal right now and run 100,000 income scenarios and see what happens to our 86% number. Here we go. Well, that's not great. Our 86% number just became 80%, which means we have a 20% chance of failure, meaning a 20% chance that one of us, a husband or a wife, or for example, would run out of money. Now, there is something else we can do, of course, right? You cannot live as long, right? That's not a fun one. But what if you just simply took out less money? Here's the thing. The safe withdrawal number nowadays is not really 4%. In many cases, it's actually below 4%. The real answer here is, in this case, if there's no other plan for retirement income, you might have to take out less money. So what happens if we drop this down to 3.5%? What if we take a pretty big pay cut and we run the same calculation? Remember, we were at 80% chance of success, and now we're running 100,000 calculations, and there you go. We have a 91% chance of success. All you have to do is cut your lifestyle dramatically, and whammo, you're okay. Now, of course, I'm being facetious. Nobody should be looking forward to taking a huge cut in lifestyle. That's why retirement income planning is actually, in my opinion, a science. It's an engineering challenge. It's a balancing act. So there you go. You can check this out at Vanguard. Google it, the Retirement Nest Egg Calculator. If you have questions, you, of course, can send me an email. I'd love to go over your specific retirement income plan, connect all the dots, and help you with that. But this is the Retirement Nest Egg Calculator from Vanguard. There are many different Monte Carlo simulations you can use. All right, there you go. That was the Monte Carlo simulation. Not a terribly exciting conversation, right? Wait a minute, I can earn 10, 11, 12% average rate of return according to financial gurus and advisors, but now I really should only take out 5 or 4 or 3%, 4%. How can you live on that? Here's the thing. Maximum retirement income does not happen with a singular product or one singular move. Maximum retirement income, lifestyle income, happens with a combination of things. It has to be your investments, working with your real estate, working with your insurance, working with all of the different pieces of your personal assets and your personal estate planning. Once you put it together in an overall conversation, maximum income. That's the plan, right? It takes a strategy, not a product. If you'd like to look at your retirement income and maximizing retirement income for you and your family, if you got your kids out there planning for retirement, moms and dads, if you personally especially, send me an email, Kraig with a K at kraigstrom.com, Kraig with a K kraigstrom.com. And please, wherever you're watching this video, like it, share it, comment on it. It really helps a ton. Take care. Talk to you soon.